Doug Vanderay. I'm a CPA and recovering attorney from Grand Rapids, Michigan. It's okay. I take pills for that lawyer thing, literally. Turned back from my evil ways 20 years ago. Haven't sued anybody in 17. Should be safe for us to be in a room together, especially one where we're socially distanced. Ground rules for class with Doug are usually somewhere between slim and none. Do not think you need to wait for an official break time to go up and get a cup of, refill of coffee. And if you're going, you might just want to bring me one black. I don't need any of that other stuff in there. We got to keep the caffeine level up here, okay? All right. Wow. What a year. Tax-wise, I didn't think we were going to have much to talk about this year. Last December they had the extenders were passed and they kind of pushed everything out through the end of 2020 and they went home. And I would thought there would be no more new tax law the whole year because they were all going to be too busy fighting in the election season. And I also made the prediction that you guys were going to have a pretty good tax season. That we'd gotten past the TCJA, the IRS had kind of figured a lot of it out, in the forms and instructions, and your software was starting to mature, and I thought it was actually going to be a reasonably good year. Not a great one, but boy, did I get that wrong too. Oh, man. This has been interesting. Congress has been really busy. And then the IRS has been trying to catch up, providing guidance not only for the TCJA, where they still got a couple more years of projects and writing regs and giving us, fleshing it out. Because forgive me, that was not a well-drafted piece of tax legislation. Congress left holes you could drive a Mack truck through. So they got that. But then we got all of the COVID stuff that the IRS has been scrambling to deal with. And then they started doing something that's kind of interesting. They're now starting to slip things into the forms and instructions that are critical to avoiding penalties under Section 6698, failure to file a complete and accurate return. And they're really looking to up enforcement in a couple of areas there, particularly partners and S-Corp shareholders basis. They're really coming after that this year. So we're going to hit that fairly hard after lunch this afternoon. But it's an interesting new development. All right, so I got a hit list of things. Okay, what's been going on? And this morning we're going to try and focus more on the individual side and save a bunch of the business, okay? Because I got to try and make something flow and make sense here. So, last December, in their mad rush to go home for the holidays, Congress passed something called the Further Consolidated Appropriations Act, 2020. What's with the comma? We see that a few times here. Apparently, I don't know about you guys, but I remember when my firm, when Mitch Burgers sent out, it even got named this, the apostrophe memo. He sent this blast to the entire firm lecturing us on the proper use of the apostrophe for punctuation. Clearly, someone in Congress has sent out the comma memo, because we're seeing that pop up in a lot of places. This was really one of those crazy continuing spending resolutions that Congress passes from time to time because they have lost the fine art of actually passing a budget and the 11 or 13 separate spending bills that you need to properly run this country. They just, I don't know what happened. I think they gave it up for Lent years ago. So okay, they kicked the can down to the end of September, continuing spending resolution, got them through the end of the federal government's fiscal year, and then they very quietly kicked the can again in September to, I believe it was only the first week of December. So I expect when we come back in the lame session, sometimes after Turkey Day, There are going to be a bunch of stomping and yelling and screaming about, government shutdown or extending the spending or whatever it's going to be. Now, just about everything that had expired turned into a pumpkin at the end of 2017. Things that got left out of the Tax Cut and Jobs Act, like a game of tax musical chairs, those things got reinstated, retroactive, and extended through the end of the year. Same with things that kicked off at the end of 18 and again at the end of 2019. Everything, it pretty indiscriminately got reinstated and or extended. So it's all been pushed out through the end of 2020. Once again, from a tax point of view, there is really nothing that Congress needs to deal with in the lame duck session. They kind of took all the tax off the table. I think that was a conscious decision. So what have we... it's advancing on me, isn't it? All right. So on the individual side, they extended, reinstated tax-free cancellation of debt on a principal residence. Now, that's a pretty neat thing. It's cool. I didn't think we needed it then. Remember, this was put in when? Like 2008, 2009, the housing crisis, the financial crisis, when people were losing their house. Prices had fallen. And so a lot of people found that they were getting foreclosed and they were upside down. They actually owed, this is advancing. I hate that. Hang on. There's that one. Let's take that off. Cool, okay, better. And so, that was important when people were getting foreclosed or doing a deed in lieu of foreclosure. But where were we in the fall of 2019? The economy had recovered. People were making money. Housing values were up like nobody was upside down. And with near record levels of employment, there weren't a whole lot of people getting foreclosed unless they'd done something really stupid. And so I didn't know why this one needed to be extended. Did they know what was going to happen with the COVID coming? And how people were going to be laid off, furloughed, businesses closed, restaurants, bars, gyms, yoga studios all shut down for months under governor's orders? Therefore, people, maybe? I'm not that much of a conspiracy theorist, but you gotta wonder, what was the point of this? Now, they pushed it out through the end of 2020, which really doesn't help us. The people who are going to lose their house because of the COVID and the economic disruption of the pandemic are not going to be dealing with, it takes time for default and foreclosure and all to move through the courts and all of that. Nobody's going to get that happening to them yet this year. That's all going to be a 21 or a 22 problem. This is one Congress has got to come back for. So as you start to see clients in that situation, keep your eyes on the news for this one. All right, treating your mortgage insurance premiums, your PMI, as if it were additional mortgage interest expense. That's a nice one. It's a little deduction. I don't know if it's worth going back on a standalone basis to do an amended return for, but you'll look for it as you're preparing your returns this coming season. Anybody who's got PMI, hey, okay, now look back at 19 and 18 and see if as long as we're at it, we can spend an extra few minutes, pick them up some extra money. Especially if we're looking at people where we may be doing NOL carrybacks and amending returns and doing stuff anyways. Make it more efficient. We'll talk more later about the 7.5% of AGI threshold for medical expenses. Good one for particularly older clients. For the younger accountants in the room, you know the importance of this one. The above-the-line deduction for post-high tuition and fees. You know, that $2,500 American Opportunity Credit is great for 4 tax returns, which, if you think about it, gets you or your parents first semester freshman year, freshman, sophomore, sophomore, junior, you know, and then we go fall, boom, you're done. What happens for that spring semester of senior year, or you young accountants dealing with the joy of the 150-hour requirement? What about other people going for a master's degree or going back to college later in life, maybe changing direction, picking up a nursing degree or teaching certificate or something? They were SOL since 2017. Now we have the opportunity to pick up and give them the above-the-line deduction for that. You know, it's a big deal. And then Congress got the Secure Act, which started to get some attention from accountants this spring, and then we got COVID. And everybody just kind of forgot about this. So let's take a look at what's there. First, you know that when you get old, the seniors never want to take money out of the IRA or retirement plan. They don't. They wouldn't if they could help it. Why? Because they've heard all the horror stories. They are afraid that they are going to run out of money in retirement. Social Security won't be enough to live on, and they're going to be forced to eat cat food. You know, all those horror stories that they tell on the TV news. Well, so they wouldn't. Okay, they would save every bit of it as long as they could, just in case, because they don't know what's going to happen. I understand it. But you know what? When you look at the money that's sitting in somebody's IRA, profit sharing, or 401k, and you look at it and you think, wow, that's mine. You know, I got like $120,000 there. No, you don't. Because do you understand that when you put money in and when you invest it and grow it, you are not only investing your own retirement funds, you are investing Uncle Sam's taxes. Yes, his cut of that. It goes in there. And you're investing for him. When you're dealing with Fidelity or Merrill Lynch or whatever, you're growing the taxes for the federal government. Thank you all very much. We all appreciate that. Well, excuse me. You may choose to hold off, and Uncle Sam has been waiting to get a piece of that for 20, 30, 40 years. Can't wait forever, people. We got a deficit. Uncle Sam needs some of that now. That's why we make you start taking it out. Now, you do it over the life expectancy of someone who is 10 years older than you are. So when you got there, 70 and a half, it said you would live to another 27 years. To 97. I'm sorry, people, with my gene pool, I'm not going to see 97. Okay, this is not. So they shouldn't worry so much about running out. Okay? Well, that's been fine, and that's been fine for like 30 years. 40 years, we haven't changed that. But we're doing better. People are healthier, living longer, more active as they go into retirement. So one of the things, they're going to push it back. Now you don't have to start taking money out till you hit the age of 72. That's kind of a nice thing. Next, if we were going to force you to take money out of your IRA starting at 70 and a half, why would we let people keep putting money in? It's supposed to be coming out. Now, okay, that didn't make much sense, did it? But again, live longer, healthier, and you know what? A lot of older folks enjoy a little bit of work in retirement. They may not want to work full-time, 45, 50, 55 hours a week like they did all the way through, but they enjoy doing some. They actually managed to find something to do in life that they enjoyed, and they want to keep their hands in, make a little bit of money, maybe add to or supplement their retirement fund, just in case, build it up a bit for later. Cool. Well, why not let them put money in? So one thing the Secure Act does is take away the cap on age. Now, if you have earned income, W-2 wages or self-employment income, maybe you're doing some things on the side or doing your little gig economy side hustle, driving for Uber Eats or whatever it may be, or they still own an interest in the partnership or LLC, the family business, which maybe the next generation is actually doing more of the work on, but they still have self-employment earnings coming through. Now they can make tax-deductible IRA contributions anytime they want. And if you think about it, at that point this year, you're looking at $6,000 plus an extra $1,000 for the catch-up, $7,000 each. Married couple can dump $14,000 in. So as you're coming on down year-end tax planning or you're looking at the returns this spring, that is an option, a tool we have to manage their taxes that we haven't had for years and years. That's open. Game on. The one catch is, you can make that tax-free IRA to charity transfer rollover so that you take a couple $1,000 out, it counts towards your required distribution, but it doesn't run through your 1040, it doesn't push up your AGI, doesn't phase things out. To the extent you're putting tax-deductible money in, you can't also do the tax-free distribution. I think there's a way you could double dip then, which would be a little unsportsmanlike. I don't know how this was ever legal or really worked under IRS regs, but apparently some people were setting it up so that you could take a loan out from your qualified plan, your IRA, or not so much the IRA, the 401k, the profit sharing, the solo 401k, and borrow from your plan using a credit or debit card that the company, the business would give you. This can't happen. I'm pretty sure this was one of those promoted things by people that, insurance and annuity salespeople who once upon a time also sold son of boss tax shelters. It's that kind of an abusive transaction. Rather, how could that have qualified with the plan loan rules? No way. Not if you got that debit card and you can use it anytime you go to the Target or the grocery store. That was garbage. Rather than hunting them down individually, the IRS got Congress simply to ban that practice outright in the Secure Act. Long-term part-timers now must be made eligible to participate in your client's 401k plans. Some people work part-time, year in, year out, but not enough to get, 1,000 hours a year and, to be in the plan. Now, if you are a long-term part-timer, you've worked 500 hours a year for that business for at least 3 years, we must allow them into the plan. So all of your clients really need to be looking at this and making sure. I'm guessing most of them have, master and prototype plans and all. We need to make sure that change is getting made. I picture this for the landscaper who lives across the street from me, who's got 10 or 12 full-timers, the foremen, the supervisors and that. And then you got a whole bunch of part-timers, that come, some of them are high school and college kids, others are older, and, they work from April or May into the fall, right? Every year. Got to give them the opportunity to participate. Maybe your firm has seasonal tax preparers. People who come in and, December or so, year-end tax planning and all. Otherwise, they come in January. Through busy season, they work like dogs, knocking out 1040s, hitting it out of the park. Do we kick their butts out on April 16 and say, see ya? No, they keep coming in a bit in April and through May, working on some of those extended returns and all. And they come back year after year. Like the geese, some of them are, they're beautiful people. they need to be allowed the opportunity to participate in the plan, get a piece of the matches and all of that. And I think a lot of your clients have people like that on their payroll.
Does it look back now 3 years in the past, or does it start now?
Well, the fact that we have to have that feature, I believe, starts 21. Congress gave us a year that we didn't have to have this in place in 2020. It starts in 21, but you get to look back at the prior couple working years. We don't have to wait 3 years before then they get in. That'd be a teaser. It's no secret that having a child is not a cheap experience. Whether it's by birth or adoption, it costs you a bunch, man. Adoption, whether domestic or foreign, oh my gosh, the fees and expenses and studies and report, oh, good Lord. And how about you even going to the hospital and having a baby up there at St. Alf's? If you have one of them high deductible health plans, we've got some bills waiting for you. Help people out. Congress allows you to take out up to $5,000 out of your qualified plan. It's a distribution for birth or adoption expenses. Note, this is penalty-free. You take it out, you don't have to pay that 10% penalty on early withdrawals prior to age 59 and a half. Would be a little funny if you were taking it out for childbirth after 59 and a half, but in law school we joke about the problem of the fertile octogenarian who messes up the estate plan. Remember Tony Randall from the Odd Couple TV show had twins in his 70s. I mean, you can go there. It is still ordinary taxable income, however. It is not tax-free money. But it is a great source of liquidity to deal with that. And if you know that's supposed to be retirement, you should tap it during life. Yeah, but if you have younger people who otherwise might not be thinking about participating or putting money into the plan, to think of this as a tax-favored, child savings plan, child birth plan, in that frame of mind, maybe it makes sense. All right, previously, you'd sit down with a client, March, April, June, and you'd tell them how much they'd owe with the return. Oh, that's too much money. And there wasn't a whole heck of a lot you could do about it. You could maybe do a tax-deductible IRA. $6,000 if they weren't phased out because of spousal or household income. Very little room to work with. You could talk to them then about, okay, let's set up a real retirement plan and we'll have it for next year and you'll be able to do more. But in general, it was too dang late. Now, beginning this year, as we go forward, we have the opportunity to adopt that solo 401k or profit sharing plan or whatever at any time up to the filing of the extended return for the business. Very cool. Note, that means I can set up a profit sharing 401k for my troops. I can put in an employer contribution, tax deductible for the prior tax year. They're pretty clear. You cannot go and somehow reconstitute, file W-2Cs and correct it to try to turn some of last year's compensation into, pre-tax 401k money. You can't play those games, people. All right. They made some other changes to auto enrollment safe harbor. The ADP testing is supposed to be a little easier, hopefully cheaper to administer, maybe allow you to kick things in. Previously, if your client was thinking about setting up a plan, they could get a tax credit from the government to help them offset the cost of adopting that plan. $500. Whoopee! That didn't go anywhere towards dealing with the out-of-pocket costs, let alone the hassle of adopting a real qualified plan. Well, look what we got now. Now it's the greater of that $500 or $250 for every non-highly compensated employee who is eligible to participate in the new plan. So I think of the landscaper across the street, adopts that. You got like 12 full-timers who will be able to participate. 12 times 250, that is a $3,000 tax credit. And it's not just a one-shot deal. You get it for 3 years. $9,000? Not only will that take care of all the out-of-pockets with accountant's time and lawyer's time or whatever we do and some of that, it's also going to put money in the landscaper's pocket that maybe you use that money to fund like an employer profit-sharing contribution, your matching program for the employees for, deferrals. Yeah, this could go a long way, folks. Something to talk about at the end of the year. One of the great things that Congress did about 15, 20 years ago was give us the stretch IRA. When someone would inherit an IRA balance, previously you pretty much had to take all the money out, which meant it was all going to bunch, it was going to rocket you up into the higher tax brackets. It got real expensive. Real expensive. Stretch IRA would let a beneficiary take it out in substantially equal installments over their life expectancy. You could subsidize, augment their standard of living all the way through life. It was very cool. Really was. When you would pass it down, particularly to a younger generation, think about it. If you had that IRA now being inherited by somebody in their 20s or 30s, you do the stretch. It's actually, the withdrawals every year are less than your expected earnings and growth, all the way up until their 50s, early 60s. So the balance is going to grow, build, defer, all. It was very cool. Well, once again, hey, they needed the money. And so here is an offsetting tax increase. No more stretch. Anybody kicks the bucket in 2020 or later, the beneficiaries generally can't stretch. They got to take it out within 10 years of the date of death. Now, you can take it all out in one lump sum in year 1. You can wait until year 10 and take it out all then. Or you can do, a little bit every year for 10 years or 3 or 5, whatever. But 10 years, it's got to be out or we're going to drop the hammer on it. Exceptions are for surviving spouses and stretch. Why would you do that? Can't a surviving spouse roll it over into their own? Yeah, but what if the surviving spouse isn't 59 and a half and won't be for a while? Think of somebody who passes away in their 30s and 40s and they're still raising kids and all of that. The surviving spouse might like that income stream from the stretch coming out to help. Interesting tool. We can do that. Children who have not yet reached the age of legal majority, 18 in most states, they still have the opportunity to stretch. Chronically ill individuals, they don't know what their life expectancy is and they have bills all the time. They can use that year-by-year supplement very much. Finally, if your beneficiary is not more than 10 years younger than you are, they can stretch. Okay? Congress is really, cutting off the multi-generation thing where we pass it down to the grandkids or something like that. So, you have 2 siblings. And your beneficiary designation says half goes to my sister and half to my brother. Your sister is 6 years younger than you are, less than 10. Your sister can choose to stretch. Your baby brother, born 12 years after you. Yes, mom and dad had one of them little tail-end surprise things. Hey, I identify with that. You asked that if I have 3 children. They are age 26, 29, and 16. You're allowed to laugh. Depending on what day of the week, it is either a tail-end surprise or started a second family with my first wife. It's all very good, okay? But I can identify with this. Your baby brother, more than 10 years younger than you, does not have the opportunity to stretch. Okay. All of this brings up the question of, is it time to rethink Roth IRAs? You know, I'm a tax guy, and so, you know, the Roth to me is a non-issue. You know, I really have, doesn't affect this year's return, doesn't affect next year, it never affects, it's not a tax thing for me. I understand you're looking at the present value and, okay, cool. Now all of a sudden I start getting real interested in a way I haven't been previously. You know, no more stretch. You know, that required minimum distribution from a traditional IRA versus there's no RMDs required out of a Roth. Can leave the money in all the way till you pass. Traditional IRA is probably one of the worst things you can possibly leave to the next generation. Because it's all 100% taxable, no step up in basis. No, you ought to spend the traditional IRA on yourself in your retirement like it was meant to be done and pass other, better assets to the next generation. Roth IRAs don't have. They come out tax-free when they're inherited and the next generation gets it. And then the traditional retirement has always been premised on an assumption that you put money in and deduct it on taxes or have it pre-tax when you are in your prime earning and working years. When we assume you are going to be at or near your highest lifetime tax rates. I'm not convinced that assumption is accurate right now. Right now we are in the TCJA period, which for advertised 8 years dropped income tax rates just about across the board. Even more for your business owners getting the 20% Section 199A deduction. We are in a period of what appears to be historically fairly low income tax rates. And even before the election, people, we have a deficit. $1 trillion a year as far as the eye can see. This cannot go on like that forever unless you want to change our name to the United States of Greece. They may have to deal with that deficit at some point. And then we have the election and some of the tax increase plans. Not only of Biden-Harris, or as I like to refer to them, 46 and 47. But how about the people in Congress, including many of the candidates in the Democratic primary with their taxing? And don't just watch what they say about income tax changes. I want you to go back and read the articles that Tony Nitti wrote in Forbes and others. It is the Medicare for All and some of the other spending plans that are where the real interesting tax increases are. Okay? So, with all of that, is that assumption that you are going to be in a lower effective tax rate in retirement X years from now than you are now going to be accurate? This all makes me think Roth in a whole new way that I hadn't, peeps. Just saying. Also, Roth conversions can be very expensive, can't they? But in the COVID, when people's incomes are down, if they got losses passing through, you may have a window of opportunity there to do a Roth conversion at a fairly low tax cost. Just saying. All right. So the Secure Act had been passed by the House of Representatives back in May. May or June. Overwhelming bipartisan basis. Republicans and Democrats holding hands, hugging each other like Dianne Feinstein. Why? Did you know the vote was like 394 to 6 in the House? There were only 6 congressmen who voted against it. One of them was my own representative, Justin Amash, who never votes yes on anything. Nothing is ever good enough for him, okay? You know, the perfect is the enemy of the good. Nothing's ever perfect enough for Justin, so he just votes no on everything. Well, and then it got tacked onto the continue. Why? Why could there be such overwhelming bipartisan support of something like this? It was driven by the insurance companies. They see trillions of dollars in qualified retirement plans, assets under investment that they couldn't get a piece of. They couldn't sell annuity contracts to it. You know, they had to wait until somebody would leave the job and roll over, and then we could try and sell an annuity. Guaranteed, don't lose money. You know, next time, don't lose 20 or 30% the next time the market goes down. You've heard all the ads on the radio and all the rest. Yeah, they want to sell annuities with front loads and commissions and management fees and all that. Way more money. Now they get to it. Now they have the opportunity to have the employer add annuity contracts as part of a diversified investment menu within the plan. That's what drove it, the insurance companies. The kiddie tax. You know, it used to be, in this country, we don't like inherited wealth and silver spoon kids, okay? We really don't. So previously, the kiddie tax would take the unearned income, interest, dividends, you know, capital gains and stuff, of all of the kids and pile it on top of mom and dad's return, try and push the family up into a higher tax bracket, stick it to them, and then we allocate the tax back to the kids. Okay, fair enough. The TCJA, Congress did try a few things there for tax reform of tax simplification, and this was one of them. They decided to simplify the kiddie tax by treating the little snots as if they had died. Yeah, just treat them like a stiff. And instead of having to deal with it at mom and dad's return and all of that, we were going to stick it to them at the punitive rates and brackets that we hit dead guys in their trusts with, where you hit the highest individual income tax rate, 37% at like $12,500. What that meant is that often, you know, particularly when we would inherit from a grandparent, you know, we're saving for the grandchildren, the children, would often be paying 32, 35, 37% on that, when mom and dad were only paying 12, 22, or 24. Okay, we might want to stick it to inherited wealth as a country, but that's getting a little punitive, okay? That was vicious. So the Secure Act repealed that, unwind it, and reverse it. So now we go back to the old kiddie tax rules. Take it all, put it together, and pile it on top of mom and dad's. Now this is both good and bad. The bad is that at least the last 2 years, you could actually e-file the little kid's return in February, March, and April, instead of having to extend it and wait till we work on the parents in the summer and all that. No, can't do that anymore. Now we're going to have to hold off and wait. That's the bad part. The good part is now we're going back, and for some of them, we're going to save them some money because we're going to calculate their liability at what I like to call the consolidated family return rates. It's like a consolidated return for the entire family unit. Not bad. This is effective for 2020. That is the way you must do them this year. If you choose, you can go back and amend 18 or 19 if you have some of those kids who were punished by the change in the kiddie tax. Your option. And then, like I said before, Congress did a really lousy job drafting the act. Now, I'm not talking about policy and decision and was that a good idea or a bad idea. I'm talking about writing the law. Something that guy who goes to law school kind of cares about a little bit, okay? And they were just sloppy, crappy. They were in a hurry to get out of town for the holidays, and boy, it shows. Like when one of your kids is, has a 5-page paper that's due tomorrow morning, and it's about 2 a.m., and they're just slapping out some kind of crap, they don't care anymore. That's how Congress did it. They passed the TCJA, they went home, we got a chance to read it, and almost instantly there's a list of like over 90 things that they screwed up. And by that, the technical corrections are not things like, oh, maybe that kiddie tax thing was a bad idea, let's go. No. Things where the law doesn't do what it's supposed to do. They didn't write it well. They didn't. Well, unfortunately, here we are almost 3 years later, and they still have not managed to pass or advance that package of technical corrections. With one exception we'll talk about in a little bit. And then came the virus from China. Oh boy. Yikes. And in response, the federal government particularly has responded with a whole bunch of changes. Various relief. We got the Coronavirus Preparedness and Response Supplemental Appropriations Act, note the comma, 2020, okay? The comma people were still in charge. I think they'd have a little coup in Congress, and the comma people managed to overturn the people who put all the cutie pie names together. Don't worry, the cutie pie is coming back. And this was just the first knee-jerk response to throw $8 billion at local governments in order to buy personal protective gear and respirators and all of that. This was just authorizing panic money. Then the Families First Coronavirus Response Act. We'll talk about that one. Phase 3 was the CARES Act. Okay, here's where the cutie pie name people come back in. Okay, we got that in the CARES Act. They had to come back again and tweak that. See, I don't consider these next ones like Phase 4 or Phase 5. That's like really modifications and piling on the CARES Act. And at this point, this is, I think, all just damage control. It is not stimulus. Okay? This is damage control. They were trying to avoid the second Great Depression, just like the first depression was set off by the stock market crash in 29. That's what we are flirting with the edge of, and they've just been throwing money to avoid that. So far, reasonably successful. I mean, with the stimulus checks this summer and all, consumer spending did not collapse, and we're there. This is damage control. Okay, I'm a sailor. Okay, I'll tell you stories about that later. But when we're out racing on Lake Michigan or Lake Huron and you hit a submerged log, they leave them floating out there sometimes. You got a hole in the boat, there's water pouring in. Boy, have you got a problem. We got to try and shove things, stop the flow of water, slow it down, start bailing, to keep this sucker afloat. We don't want to sink it. No, the most effective bilge pump in the world is a scared sailor with a 5-gallon bucket. It'll work. It will work. This is damage control. That's all it's been, okay? We haven't even begun to focus on stimulus or rebuilding, okay? This is not like President Obama's stimulus bill in the spring of 2009 with $1 trillion for shovel-ready stuff and all. No. We're just trying to stay out of the next Great Depression. And then Congress shut down. I mean, we did all that stuff in what, March, April, and then nothing. As Washington pretty much shut down for the election season. The president tried to do something, a way to throw additional money into people's pocket and into the economy as we go through the fall. Do this by an executive order, permitting employers to defer, postpone withholding deposit and payment of the employee portion of Social Security, not the employer portion. Because we will see later that in some of the phase 3 things, they'd already given the opportunity to defer the employer part. That was already gone. It's off the table. So we can do this. Deferral allows you from September through December to simply not take 6.2% out of people's paychecks for their share of Social Security. And in effect, you're going to give people, well, somebody's got to do the math who's better than I am, but because it's 6%, it's going to be like, they're going to see like a 7 or 8% increase or raise in their take-home pay when you don't take Social Security out. That's cool. That is money in the pocket, in the economy, working for everybody through the end of the year. I get the idea. The only people you can do it for is really those earning about under $100,000 a year and change. Not the big dogs, okay? We figured they ought to be able to survive this as they're still getting paid in the fall. Okay? But the president doesn't have the power to waive Social Security taxes or to forgive them. And maybe that's a good thing. Did you know that I am a tail end of the baby boomers? Yes, I am. And as long as I can remember, going all the way back to my college classes, they've said Social Security is going to run out of money. Yep, it's going to. In fact, what is it? Is it now 4 years in a row the Social Security Trust Fund has paid out more in benefits than it's taken in taxes? I knew it was 3 in a row. I think we're number 4. They don't talk about that on the news much. In fact, the last projection I saw showed the Social Security Trust Fund flat broke, clean run out of money the year I reach age 67 normal retirement. This is not looking good, people. We can't mess with it. No, when the trust fund runs dry, they won't stop sending out Social Security checks. They will, however, have to reduce benefits across the board by 20 to 25%. So that the checks going out match with the Social Security taxes being paid in currently. So waiving, forgiving, that is not a good idea. And so we got to catch up. And so the president's executive order says, okay, come January of next year, you will double withhold the employee's Social Security taxes. For 4 months. Yeah, it's that whole payback is a B word. It's not a nice word. You're not allowed to use it in public, that kind of word. Yeah, it's payback time come January. Well, think of what happens to people's paychecks. They've got what seemed like about a 7% raise this fall. And then come January 1, not only do we cut their take-home pay for reinstating the normal Social Security taxes, we take the extra off too. And so their pay is going to go down by like 15%. Can you imagine how all of these semi-educated high school graduates are going to be in, screaming and yelling and ripping it, yelling on the boss for ripping them off and pay cut and oh God, awful. There's a reason why many employers have chosen not to do this, okay? Here's the big one. What happens if the employee leaves? Starts playing Johnny Paycheck on their iPod. You can take this job and shove it. Or, the business closes, or you lay them off, furlough or terminate them because they're a bum, whatever. The employer is on the hook for the employee Social Security taxes that it failed to withhold and promptly deposit with the federal government. And would that be one of those taxes that would be subject to the 100% penalty on responsible persons? Yeah, there's a reason the federal government is about the only one who's done this. Really. The more I think about it, the President's executive order, is a payday advance loan. You know how if you need car repairs this week and you don't have the money, you can go to one of them payday advance stores in the strip center and they'll give you a loan till next Friday? This is a payday advance from the fall to the spring. And now, it's a little different. It's free. There's no interest, and there's no, veto the loan shark fees like there is with a payday advance loan. But that's what it is. And you go to one of those paycheck advance people, it may get you through your car repair this week and until next week Friday, but then there won't be enough in your paycheck on Friday to pay the bills then. It's the same problem. It's a little different, though, than the normal payday advance loan, because this one is guaranteed by your employer. If you're not working and you can't pay it back, your boss will pay back your payday advance. That's what that program is. The IRS wasn't real excited about it. When they like something, they can turn out hundreds of pages of guidance and read it. 2.5 pages is all they had to say about it. Till about 2 weeks ago. They chimed in again and said, for the employers who are doing this, and some of you will have to watch for this coming through on your W-2s this year. The employer is going to report all of the employees' wages as normal in boxes 1, 3, and 5. Okay? All the Social Security wages that were paid will be reported in box 3, or what box 7 is like for railroad workers or something like that. Yeah. But the deferred employee taxes won't come out and won't show up in box 4. Note when the younger accountants are entering things into the software, a lot of time when you put in the taxable wages, it tries to autofill because it assumes you had the right amount withheld. It might be very different this year. Be very cautious about the autofill feature on those. Then, come next year, January through April, when the employer starts double withholding the Social Security wages, not only will that happen, but then the employer is going to have to go back and file a 2020 W-2C, a corrected W-2, in order to show that the taxes were actually paid for last year. And so you can expect some of your clients, what do I do with that? Now, for most of them, you won't have to do anything and you will not have to file an amended return. Okay? Now, you can just try to get them to settle down. That's all it is. But the IRS pointed out, there are some people who have too much Social Security tax withheld from their paycheck during the year. If you work at multiple employers, and so, you work, get paid $80,000 at one and $70,000 on the other, because you shifted part year, you had $150,000 of taxable wages paid to you, but the wage base was only what, $137,700? So don't we have to do something on their return to get them the refund or the credit of the excess Social Security? For those people, You're probably going to have to, either extend, you'll see them if you're looking for the issue on their return. You'll either want to extend their 2020 return, wait till the W-2C comes in, probably not until May or June, right? Because they're withholding through the end of April, and then file their return. Or if they got a refund coming, they need the money, okay, explain to them, when we get the W-2C, we will need to amend, and we'll be able to get you a little bit more. Whew, all right. How about the Families First Coronavirus Response Act, Phase 2 of the COVID legislation. This one targeted to small employers and providing things called paid sick leave, family medical leave, and more. Now, for years, we've had something called the Family and Medical Leave Act. Federal law. If the employer has, 20 or more employees, they are required to give you up to 12 weeks of unpaid time off to deal with the business of life. Things like having a baby, being sick, going through chemotherapy, your mother-in-law in hospice, the real business of life. 12 weeks of unpaid time off, and your job has to be there when you get back. When I describe that program, what is the one most important word I use? Unpaid. And you know what? It's no secret that most of our friends and neighbors do not listen to Mr. Dave Ramsey on the radio. That's that Dave Ramsey. Debt is evil, you must pay. And you must have 3 to 6 months of living expenses in a bank account. And so when the business of life comes up, birth of a child, chemotherapy, family member in hospice, they can't take 12 weeks off without pay. There's no way, they ain't got the money in the bank. How the heck are they going to cover the rent, the mortgage, the utilities, and all the rest? So no matter how badly they could need that time off, they can't take it. That's the problem. Some states have begun mandating or talking about mandating paid time off, even pre-pandemic. Congress has decided to address that with these provisions that I think we'll talk about more on the employer side this afternoon. And then we get the big kahuna, the CARES Act. Over $2 trillion with a capital T of government spending. As a yardstick, President Obama's stimulus bill was only 1 T. So, kind of like TV poker. We'll see your bet, I'll double it and raise it. Okay, there's a press release in there somewhere from our friends in Congress. Whole bunch of things on the individual side. We got our stimulus checks this summer, actually called rebates. The ability to take penalty-free money out of a retirement plan, loans, borrowing from it, waiving required distributions this year, charitable deductions, and more. First, what the statute and the IRS calls the 2020 Recovery Rebate. This is a refundable 2020 tax credit that you will calculate for them on their 1040 for this year. But kind of like the old days, how we would have the earned income tax credit, and you'd calculate it on somebody's return. But if it looked like they were going to be eligible for it going forward, you could use, and they would get next year's EITC paid to them in advance as you go through the year. This was in advance, a prepayment of the tax credit that we will calculate on their return come springtime. Well, how are we going to send the checks out? Because there's phase-outs. You make too much money, you don't need that kind of stimulus. You're supposed to be able to take care of yourself. Well, the advance payment was to be calculated based on last year, the 2019 AGI. What about all the returns that were extended, hadn't been filed yet, or the ones sitting backed up in the IRS offices? What? Did they have they admitted to 11 million pieces of mail this summer that they hadn't even opened? They had no clue what was in any of that? Last I heard, they admit it's still over 5 million. They won't say how much. So the IRS didn't have 2019 in the computer. Congress told them, look back at another year and look at 2018 for phase-out purposes. How much? Woo! Kind of big money, folks. $1,200 a head, so that's $1,200 for a single, $2,400 for a married couple, plus $500 for each of the little rugrats. My older two children joke about the hug. Because when they were small, even very small children, they knew exactly when Doug had pressed the button on the computer at the office to e-file our tax return. Because I came home and I gave each one of them a very big and a very special hug. Because I appreciated them for who they were and what they meant to me. That personal dependent deduction of about $4,000 each, the child tax credit, I get to claim them on my Michigan until they turn 400 or 14. I got an extra $700 for each of them. I mean, man, I appreciated those kids on that day. They joke about the hug. A lot of kids got extra hugs this summer, not only around April 15. It was a good thing. $500 a head. Make too much money, though, we take it away, people. 75,000 single, 150 married filing joint. Note, it is AGI, not taxable income. So now, figure that in your head. Subtract the single person standard deduction this year of, I believe, $12,400. Oh, so you really lose this at about $62,500 of taxable income and start taking away your stimulus. Married couple, $24,800, so knock off about $25,000. $125,000 in taxable income, and we start taking it away. And we take it away fairly aggressively. $50 for each 1,000 over. You lose $500 of credit for every $10,000 over. So we got some work to do managing taxable income for some of those people on their 2020 return. Now, we will calculate the credit they're actually entitled to for this year on the return and compare it to the check they got over the summer. And if they are, in fact, they were limited, phased out in part or in whole due to their 2018 or 19 AGI, and now either with the COVID dropping their income, or we do some things with like IRA contributions, they bring them down, we can actually get them an additional amount or some of that back that they didn't get this summer, added onto their return. What if it goes the other way? If they were phased out or they got the full amount and now their income's good because they've been essential, they've been in demand, they've been working overtime, good things happening. This is not like the Affordable Care Act premium subsidy tax credit where if your income comes in too high, it's payback time, and payback is not a nice word. No, they don't have to pay back any excess, okay? But if they were understimulated this summer, hindsight being 2020, we get them the full credit and a refund. IRS is still trying to figure out how we deal with, newborn children that were born this year. What about kids who aged out of the system, they got too old, you know, all that stuff. Now, we will see later on, I got where the reconciliation occurs. It starts on line 30 of this year's 1040, and there's a worksheet in the instructions. Got a screenshot on that for you later. Then, penalty-free distributions out of your qualified plan. This year you may take $100,000 or less, but up to $100,000 out of your qualified plan without paying the 10% penalty on early distributions prior to 59 and a half. But if and only if your withdrawal is COVID related. What is COVID related? The IRS has just helped us out on that. COVID related eligible people are those who either the individual, their spouse, or a direct household member, somebody in your household, has either been diagnosed with the COVID through a CDC-approved test. Basically, they take that swab and they shove it up where the sun doesn't shine, or, the usual COVID test. Somebody in your household has tested positive this year, or you experienced adverse financial consequences due to the pandemic. Adverse consequences include getting quarantined, furloughed, or laid off from your employment, having your work hours or pay reduced due to the COVID. You were unable to work due to a lack of child care. Your governor shut down the schools, and I can pretty much leave the high schooler alone, and all that, but man, you got those lower elementary kids, K to 5, you leave them home all day while mom or dad goes to work, you will get a visit from Child and Family Services, won't you? And if you can't find child care, because a lot of the child care was closed, can't work. Somebody had to stay home. Those people are eligible. You owned or operated a business that has been closed. Your governor shut your restaurant, your yoga studio, your work, anything was non-essential. Somebody who had a reduction in self-employment income. We had a lot of those. Because, for example, our governor shut down construction for months. So even people like plumbers and electricians and carpenters and all those trades couldn't work for months. So they'd be eligible. Or you had a job offer rescinded or a start date delayed because they just froze and pulled back. These people are all eligible to take a distribution. No, you don't have to prove you needed the money. Which is kind of crazy. You tested positive for the COVID. You got quarantined for a couple weeks, but you were mostly asymptomatic. It wasn't bad. You weren't in the hospital. You're still eligible. Do you want to take the distribution this year or not? Your choice. You don't have to show you needed it. And your distribution, your withdrawal is not limited or related to the size of the adverse financial consequences you suffered. You just were an eligible person, so you have the option. Go figure. The distribution is penalty-free. Normally, when you talk to normal clients and stuff, they hear penalty-free, they think it's tax-free. Okay, they think they get to take it out tax-free, and they all want $100,000 tax-free now. No. Pull it out. It will be fully taxable, and you may or may not be bunching income or pushing up into higher tax brackets this year. Your call, your choice. Yes, sir.
Do plans have to be amended to allow it?
I don't believe so. I've not seen anything that tells me that.
You know, if they do, that won't happen. It can't be done in time. You know, both the guidance from the IRS and then the damn ERISA lawyers and all. No. The IRS appears to be handling this administratively in terms of your eligibility to request it. Now, if you want to tap in, and you pull out $60,000, that you can pay tax on all $60,000 this year on your 2020 return. But that is actually an election. The statute appears to be set up to give you an automatic 3-year spread. So you would only pay taxes on 20 of your 60 this year, and 2020 and 20 next year, and the last 20 in 2022. So you're getting an automatic spread, hopefully keeping out a bunching of income. Be cautious about what rates you may find yourself in 21 or 22. Just for sporting. It is actually an election to bunch it, to take all $60,000 that you're withdrawing on your 2020 return. And then, if you wish, you can treat this as a loan. You take the money out, and you elect to what they're calling recontribute it, or repay it. Effectively, it works like, the best way I've seen it described is, you know how you got 60, we don't do it anymore, but you used to have 60 days to do an IRA withdrawal distribution and to roll it over tax-free? This is it's like that kind of a rollover, but you have like 3 years to do it, okay? You can recontribute or repay the money within 3 years of receipt, within 3 years of the actual distribution out of the plan, and therefore excluded from income. So, if they pulled it out this summer and they want to repay the first 20 grand before the end of the year, they can do that and make that 20,000 disappear from their return. And then repay 20 next year, repay 20 in the third year, and it all goes away. Or they wait, and they wait until 2022 to repay all 60. You know, and maybe they bunched it and had it all taxable in 2020. Then we get to go back and amend the 2020 return, exclude that repaid amount from their income, and get them a refund. Lots of options, lots of stuff you can play with for clients who've done this. Watch for a new Form 8915-E, where this is where we're going to do all the work on this for our disaster retirement plan distributions and repayments. Draft of the form came out. It was posted dated November 9, and you can't ever find that stuff until the day after the 10th. So some of this is not in your handout, because guess what Doug was working on the airplane yesterday? Okay? Keep adding it on, and this is a new one, guys, but this is how that stuff's supposed to work. All right.
Well, the 1099 will still say early distribution.
I have not seen a special code for that yet. I've heard talk that there better be one. You know, that it is COVID related, but all right. Good thoughts, guys. Remember that required minimum distribution thing, forcing the older Americans to take money out? Well, remember the COVID hit, what happened to the stock market? Dropped like a rock all of a sudden. And you know, it would be kind of punitive to force the seniors to draw money out and to take money out at the dip in order to hit their distribution based on their December 31, 2019 balance. That could be like a double whammy. And so Congress decided to give them all their option. Nobody has to do an RMD this year. It's waived. Remember, what is the penalty if you don't? You don't take out what you have to? Yeah, it's not 10%, it's 50, which is not just punitive, it's dang near confiscatory, right? And in general, many of your clients won't have taken it yet. A couple years ago, I was traveling like this, teaching class. It was right after Thanksgiving. And, the hotel, when you're there for the little quickie breakfast thing, have copies of the USA Today. So I looked, and there was an article in the USA Today where their reporter had talked to like Merrill Lynch and Fidelity and a bunch of the big mutual funds and all that. And as of Thanksgiving, they said that 3/4 of their seniors had not taken an RMDA distribution for the year. Now, I looked at that point and went, oh crap, thinking about the penalty exposure. On the other hand, right now, I look at that delay, postponement, procrastination, year-end thing as an opportunity. That some of those who might have been for now have the opportunity to pass or defer. Or to think, hey, look at where we're at, look what's happened to our income this year. Maybe I not only want to take out my R&D, maybe I want to take out more. But we have the option. Our call, our choice. Look at their return. Charitable contributions. Congress recognized that with the COVID and the shutdowns and all that, there are a lot of very serious needs in charitable organizations. And it's not just food banks and homeless shelters and battered spouse shelters and mental health and all that. Even some things you don't think of, like zoos and museums and other charitable organizations that got shut down for 6 months. So, no admissions, no fees, no revenue, no nothing. They got needs too. So, and the symphony and all kinds of stuff. So how do we encourage and reward people for that? Congress gives people a new $300 above the line charitable deduction this year for people who do not itemize. Note, this is $300 per return. It is not $600 for a married couple. And remember, they still need to have some kind of proof, receipt, documentation, canceled check, or bank record to do it, okay? It's not just an automatic extra $300. They got to show you a little bit of paperwork. Used to be you could give away up to half of your income in any year and deduct it. If you were more generous than that, we would suspend it. Make you carry it forward to the next year. And if you couldn't use it up, you were too generous in the next 5 years, it would expire. TCJA bumped it up to 60%. Why? I mean, really, what portion of your clients on a regular basis give so much to charity that they can't deduct it all, giving away more than half? I can name a couple, but they're pretty unusual people. Bless them. Why do we need to? I don't know. Now with the COVID, however, where particularly people, business owners and others have got losses flowing through and receipts are, all of a sudden their income's down, we still need them supporting charities and causes and churches and schools, all the social service organizations. So Congress bumped it up to 100% of AGI this year. which is very helpful as long as you have positive AGI for your client. If your client is going to be in an NOL situation with those losses coming through and doing the carryback and all, hey, I don't care if it's 50%, 60, 100, 120% of AGI. When AGI is 0 or negative, you get nothing, folks. Absolutely nothing. This helps, but only to an extent. Corporations, C Corps, are limited to donating 10% of their taxable income. Do you remember when Ben & Jerry's ice cream was really owned by Ben & Jerry? Two hippie refugees from the 1960s? Yep. They had, in their articles and bylaws and corporate governance and all that, Ben & Jerry's ice cream was required to donate 10% of its profits every year to worthy charities and social causes. Why only 10%? Frickin' cheapskates, why not 20? Why not 25? Come on, man up! Do your fair share. Well, no. They might have been refugees from the 60s, but those two guys were right. They knew 10 was all you could deduct. Beyond that, the tax law gets punitive. And so they stopped there. Paul Newman's spaghetti sauce and others do the same thing. Well, that's all good, and you can plan your charitable giving and your support of the United Way and all the causes based on your income. But what happens when income goes like that in the pandemic? Congress raised it to 25% this year. Again, that only helps you if you have positive taxable income for the year. Not going to help much if you're in a loss situation. Oh, okay. Going to give you a refresher about a couple things in the TCJA. Congress did a couple things there as part of the act that really adversely affected our ability to take and deduct normal business losses. When I looked at those, and I talked about them in class, I said, these three combined, we're going to make the next economic downturn or recession far more challenging for the business community. Oh, yeah. Well, first one. Used to be able to deduct 100% of an NOL against your ordinary taxable income. But remember how the AMT would cap it to only 90%? So you could have clients with really large NOL carryovers that still couldn't wipe out all their taxable income. I had a client in Michigan. We led the nation into the recession in the early 2000s. I had a client, excavator, ran up a $2 million NOL carry forward. Brutal. Fortunately, he had a couple very good real estate investments that threw off $400,000 to $500,000 a year in taxable income with cash flow to match. That's how you can survive a $2 million NOL and live to tell about it. Well, he couldn't get it into his thick head why he had to make estimated tax payments. He had a $2 million NOL. He shouldn't have to pay anything for 4 or 5 years. Yeah, but John, I can only wipe out 90% of that. You're still going to have to pay tax on $40,000 or $50,000 a year. I can't fix that. And if you don't make estimates, we're going to get a penalty too. Oh, that ain't right. The AMT was not repealed in the TCJA. They raised the entrance point. It's still there, but it's less of an issue. But I've said the AMT really did a hostile takeover of the tax code. And here's one of the prime places. They said, oh, that was a great AMT rule. We're going to do that to everybody. Now you can only wipe out 80% of your taxable income with your NOLs. Ooh. And then the old rule used to be back 2 and forward 20%. So when one of your clients had a loss, you would walk on down the hall to one of the younger accountants and say, here, prepare Form 1139 or 1045. Carry that loss back to the prior 2 years and wipe out all of their taxable income and get them a refund. The IRS promises to process those 1139s and 1045s in an expedited fashion. You, me, and everybody else in the world called it the quickie refund. No more quickies. No more 2-year carryback. No more refund. No more cash infusion to help your clients survive that loss. No more quickies. Farmers and insurance companies could get quickies, but nobody else. And then they said, okay, well, we got to give you some back if we're taking it. We'll take off the 20-year limit. You can carry your NOL forward as far as you need. Forgive me, people. Why? What's the point? Seriously, if you can't earn back the money you lost in less than 20 years, give it up. It's not worth it. Find something better to do with your time and effort and money. This is not the place for you. And then we got Code Section 461L, what they called excess business losses. There was nothing excess about it. It just meant you really lost your shirt. You were losing more than $250,000 or $500,000. That's a bad year. Well, we're just not going to let you deduct more than $250,000 or $500,000 a year. And the rest gets suspended, carried forward, added to your NOL, only allowed to use it to the extent of 80% of your then future taxable income. Yeah, adjusted for inflation, the numbers for 19 were 255, 510. The third of the 3 evil stepsisters of the TCJA was this one. Section 163J, the interest expense limitation. Yes, this is where Congress was apparently listening to Mr. Dave Ramsey on the radio, debt is evil, all of that. And although not forcing everybody to pay off their business loans and all of that, just said we're going to limit how much interest expense you can deduct as a way to limit or restrict your leverage, your borrowing, and your debt load. Cap it at 30% of adjusted taxable income. Tax EBIT. Taxable income before interest and taxes. Take that, multiply times 0.3. That's how much interest expense you could deduct. Now, until 2022, so for 18, 19, 20, 21, we can use tax EBITDA. Also add back or take 30% of our depreciation and amortization. I don't know what you saw around here. What did your clients have for taxable income in 18 or 19? Economy was doing good. They were making money. But by golly, weren't they buying? Weren't they using that 100% bonus and 179 to wipe out, really? Without this, the limitation would have hammered businesses already. This put it off, backloaded it for 2022 and beyond. But now he's sitting there. He did the calculation for one of his clients on the back of the napkin. He goes, okay, nothing to worry about. 23, 24% tax EBITDA, we got no problems. And he'd be right until the next economic downturn or recession, when his client is fighting to break even to stay out of the red and you have little or no taxable income. So all or nearly all of his interest expenses get suspended, carried forward, disallowed. And he could deduct it only in future years to the point that their taxable income had recovered. that under the 30% limit, they could deduct all of their then current year interest expense and have a little room left to go back at the stuff that was suspended. My prediction was that it would take 5 to 7 years to go back and get all of that interest expense back in the next economic downturn. The CARES Act, apparently somebody in Congress remembered these things when the COVID hit and said, oh boy, we can't make this any worse than it already is with the tax cut. So the CARES Act loosens all three of those very nasty provisions. They changed the NOL rules. They removed the cap, well, not remove, suspend the cap on business losses. And they modified the interest expense limitation. All three of them. Number one, net operating losses that our clients incur in 18, 19, and 20 may now be carried back again. And carried back not just the normal 2 years. Congress has given you a full 5-year carryback. The ability to take those losses back and try to get all or most of the taxes that you have paid, going back to, for my 2020 losses, go back to 2015, 16, 17, 18, and 19, and get all of that back refunded, a desperately needed cash infusion for some of our clients. The 2018 folks can go all the way back to 2013. Now, 2013, 14, 15, the economy wasn't that great for a lot of our clients. I'm not sure how much there is to go for. But they're letting us go 5 years to try to recapture those tax dollars. And this applies to all forms of business, including farmers and insurance companies. So maybe some of your farmers took a loss in 18 or 19. And they could go back 2 years. But some of it was, okay, now I can amend that carryback return, take it back another 3, and try and get them cash. Yes, sir?
They can always have gone back 2. Now they can go back 5. Do I have to go back 5? Maybe that's this person. Okay.
People ask this a lot, and the IRS hasn't officially ruled on it that I've seen, but no one believes that Congress can force you to amend your 18 or 19 carrybacks or your returns to, normally if you have a loss and you choose not to carry it back, you have to make an irrevocable election to go forward only. They can't make you go make that kind of election or that kind of choice for a closed year and for filed returns. Nobody believes that's going to happen. Good thought, though. You're not the only one asking the question. Truly. You may, as normal, elect out and carry your loss forward. Interesting tactical decision. You know, a bird in the hand or a tax refund in the hand may be worth 2 in the bush. It's real hard to turn down cash, tax refund now in the hope or expectation that you will be able to carry that loss forward and use it at higher tax rates in future years. What are your tax rates going to be in 21, 2, 3, and 4? And do you know how much taxable income you're going to have in those years? Are we going to get out of this crap when the vaccine finally comes around, or the next couple of years still going to be a real struggle to come on back? This is an option, but I think it takes a real gut check to forego the carryback and cash now in the hope of it being more profitable later. Now, maybe if you have clients whose income is likely to be over $400,000 a year and are therefore exposed to tax increases in the new administration, some of them may choose to make that kind of a call. Otherwise, I'm having a hard time figuring out whose. Then, Congress suspended that 80% cap or limit on use of NOLs that are generated before 21. So now my 2018, 19, and 2020 losses can be used to wipe out 100% of regular taxable income, both in the carryback years as well as in any carry forward, because the rule applies to the losses at a rise. So we got options there. Now, when you were going to walk down the hall and tell one of the younger accountants over there to prepare the quickie refund form, that was one that had to be paper filed, snail mail, or you got an IRS office here in Boise that we can go to the, yeah, you send the young accountant there with the briefcase full, and they have 2 copies, and they wait in line at the IRS counter, and you go and they give it to them, and then date stamp the one and date stamp the other, and the clerk keeps one, and you take one home with you. You can do that, but I'm not sure it gets from the IRS office in Boise to wherever they actually process it any quicker. Okay? But you got a paper file. Snail mail. Well, the IRS has decided not to join us in the 21st century. But they are, however, occasionally trying to move into the late 20th century. And here they're moving to about 1988 to 1993. And we are going to temporarily, and I mean temporarily, allow you to fax these suckers in. Do you guys still have a real fax machine? We tend to have some, but the IT people refer to them as like legacy devices and legacy hardware, I still have a landline because my mom faxes me stuff for some of her business, but come on. Yep, you can fax in those forms for your NOL carrybacks and your quickie refunds. Wow, there's something for you. What that does is that hopefully gets you around that mountain of 5 to 11 million pieces of mail that the IRS hasn't opened yet. But where that actually gets you in the processing line remains open to debate. They've posted FAQs on the temporary procedures, which some of the young accountants here are probably going to have to check out in the next few weeks. Then, the CARES Act temporarily suspended that Section 461L cap on our business losses. So now this year, no matter how god-awful your clients' losses are that are coming through on the return, $750,000, $1.2 million, whatever, we can deduct them all. They can all flow through and be part of their NOL that hopefully we can carry back 5 years and all that other good stuff. It is not repealed, only suspended. And as the law stands now in 2021, you will again have to deal with and confront the $250,000, $500,000 loss limit. So I started looking at things, guys. The fact that I go back to the no carryback and 80% use rule on NOLs that I generate and incur in 21. And I'm going to have to deal with this as the law stands now. And that tells me human nature is the same all over the country. Nobody wants it to be really bad, and if we can postpone, delay, push off, spread some of the pain, have it not look so bad this year, maybe it'll be, we tend to do that. I'm a little countercultural on some things. Here is a situation where, because we know what the tax law is, some of our clients, we've got to bite the bullet and just pile on, accelerate and pull losses and all out of 21, pack it into 2020, so I maximize what I have to work with under what are currently temporarily more favorable tax rules. I think I want to go in that direction. IRS posted this. They said, don't even look for that stinking Form 4. Oh, yeah. Code Section 461L. They put the limitation on Form 461. They think they're so. Yeah. There is not and will not be such a form this year. Great. They warn you, it's coming back next year. Clear as the nose on your face as the law stands now. Also, as you work through things, any of your clients that had a 461 in their 18 or 19 return, we can amend those guys. Take all the loss, get them a refund, and or that may push them into an NOL. We're taking back 5. It's all on the table. It's all in play. Get to take your full business loss. Do not be afraid to amend those. Although, look for other opportunities to amend to make sure we get it all in rather than amending 2, 3, or 4 times on a single client. Because there's more than one refund opportunity here, aren't there? Yep, we'll hit more of them. All right, Section 163J, the interest expense limitation that only applies if you're what? Over 25 mil in average annual gross receipts for the business group, right? 26 mil. Congress has retroactively increased that from 30% of tax EBITDA to 50% for 19 and 20 only. Now, somehow 2018 just got left out here. All the other stuff we saw them going back on, goes back for 18. 18 got left out. So I can't change that there. But now for 19 and 20, I can deduct 50% of tax EBITDA for interest expense, and the same in 2020. Now, 50% is great for this year as long as your client is in the black and has positive tax EBITDA, right? What do you do? What is your limit if they're losing money? 50% of 0 or less is still 0. Nothing. Therefore, it would all get suspended, all get carried forward, and then you're trying to scrape it and get it back over the next 5 to 7 years. So Congress also gives you the election this year, 2020 only, to look back to 2019 and to use 2019's pre-COVID taxable income to figure out your adjusted business income limit and go from there. So no matter how god-awful 2020 is, assuming they had room in 19, they should be able to deduct all or most of their interest expense this year. And then, big news! Big news! Congress screwed up very badly in the TCJA, in the conference committee itself. So this was the last minute, smoke-filled back rooms of Washington, D.C., the wheeling and dealings going on in there. And they blew it. Qualified improvement property. You guys know what that is? I got a quiz for you. We're going to pass it out and make sure that everybody, including the younger accountants, know what that. No, I'm not going to give you people a quiz. I may be a Yahoo, but I'm not that kind of Yahoo. But could you smell the fear that flashed through the room here? Yeah, I could. Qualified improvement property defined as any improvement to the interior portion of non-residential real estate. I'm going to say that again. Any improvement to the interior portion of non-residential real estate. There's a couple of restrictions we'll talk about in the afternoon. Normally 39 bloody years straight line. Lord, I hope somebody in the room lives long enough to see the end of that lapse schedule. Qualified improvement property made 179 eligible. You can expense $1 million of that in a year of what would normally be 37 or 39 stinking years straight line. How cool is that? Big deal. It was supposed to be better. It was supposed to also become 15 years straight line under makers. Yeah, it's supposed to be. It says it in the conference committee report, as plain as the nose on your face. I don't care if you have a cute nose or a not so cute nose. You get up in the morning, you go in the bathroom, you get ready to brush your teeth. There in the mirror is your nose. You can't miss it, people. This is like it. It says in the conference committee report it's been changed to 15 years straight line. Except somebody screwed up. It got left out. They lost those pages of the act. They didn't actually change it in the law passed by Congress and signed by the president. Somebody left it out. They won't say who. There has to be a name, who the heck screwed up. But this is a more closely guarded secret than the identity of the Ukrainian whistleblower. If they told you who made that mistake, they'd have to kill you for sure. Needed a technical correction. Yep. The Republican heads of the House and Senate tax writing committees sent very nice letters. They groveled to the IRS to patch this for them. Can you please, change it in the rules or regulations or something, because there will be a technical correction and we promise we're going to fix it. The IRS, I believe quite properly, declined their invitation. Because I think the IRS was right. You cannot overrule, overturn, change, or modify the express language of the Internal Revenue Code by administrative agency action. It needs a law passed by a Congress and signed by a president. Okay? It's kind of like one of them TV redneck comedians says, is it Larry the King? You can't fix stupid. You can't fix this kind of stupid with anything but an act of Congress. So as a result, for the last couple of years, qualified improvement property has been $1 million of Section 179 eligible. But the excess, if you had too much or you got phased out, you bought too much stuff, you lost 39 years straight line. Big news in the CARES Act. Congress did not include the whole technical corrections package for the 90 plus things they actually screwed up in the law. Oh, but this one they got in. And so they have retroactively made qualified improvement property 15-year maker's asset. Which, okay, I still get $1 million Section 179, and the excess is 15 years instead of 39. Whoopty, right? Well, the important thing about that is because it's now 20-year makers or shorter, it is 100% bonus eligible, people. 100% bonus eligible. How freaking cool is that? And you know, there's a lot of reasons that makes that very powerful. Now, for me in Michigan, we prefer Section 179 because our CIT, corporate income tax, the statute reads, we start with federal taxable income as if Section 168K were not enacted. My state has decoupled from bonus depreciation. So we take 179 first to the bare walls, and then we backfill with the 100% bonus. I don't know about you with your state returns here, as well as you may do some Washington and Oregon, you know, you got some, so you may have multi-states that have those issues or others. Okay? So we go the other. Some people have decoupled the other way. But you know, bonus is like freaking awesome. Why? Because Section 179 is limited to my taxable income, isn't it? You know, I can only deduct that $1 million if I got taxable income. It can never create an NOL. It can never make one bigger. Section 179 doesn't have that limitation, does it? No, it can create a loss for the year. It can make a loss you have way, way bigger. Losses that now from 18, 19, and 20 can go back a full 5 years, people. Now I start thinking, okay, what did I have for qualified improvement property? You know, and if I was capped, if I was limited, you know, now I can do it. Maybe that throws me into a loss. There's good stuff there. And it also allows me to deduct in full those building improvements, those remodeling projects on non-residential property this year that otherwise, no taxable income, no Section 179, I would have been going 39 years. Well, now I'm deducting it in full and maybe generating a loss this year. One of the reasons why I pass out the quiz for qualified improvement property is I got to ask you, who does the fixed asset additions into the software? Is it generally done by seasoned professionals, people with years of experience who care deeply and truly about tax lives and methods? No. If we're going to be honest, it's done by the rookies, the newbies, the junior accountants. We have them do it because we think the software is going to do all the thinking for them and they can't screw it up. It's worse than that. Some places, it's done by auditors on fieldwork. God help us all. You tell me what the audit senior manager running that engagement knows or cares about tax lives or methods. They don't give a rat's behind about tax. All they want to do is finish the audit program without blowing the time budget. So the young accountants asking, what do I put this in as? Kid, it's leasehold improvements. 39 years for tax, 40 years for book. Move on, be efficient. So what do we get? 39 years. It's just leasehold improvements, and you know what it's at. Now, it's bad enough that was, for the last couple of years, $1 million of Section 179 eligible. And we missed it. Okay. When that happens, and when it comes up, you're probably going to hear those 3 little words you never want to hear from a client. No, not that incredibly uncomfortable and unprofessional, I love you. But rather, I'm going to sue. They probably should sue you for that, missing that one. What is it now when it's Section 168K bonus eligible, people? When we go to sell or dispose of assets, how do we determine the adjusted basis for tax purposes? Is it not original cost or basis less all depreciation, say it with me people, allowed or allowable? Section 168K is not an election. It is an automatic mandatory part of bonus depreciation that you must take unless you affirmatively elect out with a statement, a piece of paper attached to the back of your return. And so when you miss your eligibility and you don't claim it, do you realize that the agent is fully within their rights when they figure that out to take that 100% bonus that you weren't smart enough to claim and then adjust your basis down, recharacterize your gain, and to shove it down your client's K1 as Section 1245, ordinary income depreciation recapture. For tax depreciation, you weren't smart enough to claim. Oh, you really will hear those three little words, people. It's time to put your carrier on notice. This is why I worry about things like having the youngest accountants do the fixed asset additions into the software. Nobody should be signing off on returns unless you know that a seasoned professional who knows and cares about tax lies and methods has actually reviewed the raw data input into your software. Unless you happen to subscribe as a firm to the blind squirrel theory of accounting. Yeah, you eventually the blind squirrel finds a nut, right? Yeah. All right. IRS has issued procedures. They kind of popped them out on April 17 when some of you were either quarantined or working from home or still working on your post-April 15 hangover recovery. How do you do this? You can either file an amended return for 18 and or 19 in order to claim the 100% bonus on your qualified improvement property. Partnerships, beginning with the 2018 returns. This is where we entered the new Bipartisan Budget Act, the BBA, new Unified Partnership Audit Rules. You know, they're technically not allowed to file an amended 1065 anymore. Under the new rules, it's technically an administrative adjustment request with the IRS. Or you may choose to file Form 3115, the change in accounting method. Yes, I know, a form that strikes fear into the hearts of mere mortal accountants. Most of you would rather be waterboarded by Dick Cheney personally than try to figure out a 3115. I mean, why? It's awful. It's ugly. It goes on for like 17 pages. There's all these questions and boxes that make no sense. The instructions are garbage. Nobody wants to do that. Why would you do it? You know, when I do a 3115, I'm going to calculate my Section 481 adjustment. The difference of what my taxable income would have been up till now had I always done it this way in the past versus what I did. And so I get a 481 adjustment equal to the net bonus depreciation above and beyond what I actually took for those years that I get to take now in a lump sum in the year of change, presumably 2020. Once again, making my loss bigger, taking it back 5 years and all that. In addition, so what? Why not take it? He's got a couple of clients over there that might have been a little aggressive. A couple positions taken in 18 or 19 returns that if he amends those returns, isn't he going to thereby keep open and extend the statute of limitations, gives the IRS a couple extra years to take a run at him? Do the 3115. You keep them suckers closed, guys. You don't extend the statute of limitations. Some of you may want to think about that for the right client. Once again, amended returns are one that the IRS had said must be filed, paper, snail mail, all that kind of crap. The IRS has now begun accepting e-filed 1040X amended returns. 2019 only. They won't, they haven't promised to open up the door to e-file 2018 amended returns or anything else, but they will let us do this, which hopefully will get those badly needed refunds moving sooner rather than later. We're still not ready to move fully into the 21st century and go paperless here, okay? It's progress. We'll allow it a little for the 1 year, not more. And you know the IRS doesn't believe in e-sig. I mean, they're stuck, in the 1950s with Ozzie and Harriet, and when they say signature, man, they want to see pen and ink somewhere. Well, how's that work? That's a big problem for me, with, like snowbird clients in Florida or Texas during busy season that you got pain in the butt. IRS is now temporarily, and they keep emphasizing that temporary thing, accepting some forms with digital electronic signatures. It includes that dreaded 3115 change in accounting method. The Form 8832, check the box form, so you can elect how your LLC would like to be taxed when it grows up. All of the major e-file authorization forms. That is massive! Holy cow! I can get those suckers? Oh! Especially when we've been working remotely, when clients don't want to come into the office, and that is a godsend, people. We are hoping and praying that remains the case and the rule as we go into the filing season across the board. Dead guys and trusts in that. All right, 10 o'clock. Somebody, I won't say who, I think is doing the 3-year-old potty dance in their chair. So I think this is a great time for us to take a break. Negotiating this out, shall we try to hold it to 10 minutes? 10 now, 10 now, we hold lunch to 30 minutes, and you guys get out of Dodge at 3:30 this afternoon rather than 4. All those opposed, say aye. That's the plan, all right? Quarter after, we pick it up again.